Welcome everyone. Thanks for joining the third chapter of the Financial Independentist. In today's episode, we will take a look at the federal funds rate cut announced by Jerome Powell a few days ago, and what that means for the stock market. In addition, I will be discussing a few companies that will benefit greatly from these rate cuts. But before that, let me share a quick reminder that earlier this week, we published some analysis on a couple of companies that could be great additions to your portfolio. Link in the description below. And by the way, if you like this content, please make sure to hit the like button and subscribe right now. It really helps the channel grow, and you'll even get better content in the future. Please also leave some comments below regarding this topic or how we could improve future content. Feedback will be most welcome. Alright, let's get on to it. This week, Federal Reserve Chair Powell indicated in his speech after the FOMC September meeting that the FOMC had agreed to cut Fed rates by 25 basis points and left the door open for another cut later this year. To support this decision, Powell alluded to worsening labor risk, GDP growth moderation, and inflation concerns. As a result, the FOMC lowered the federal funds rate target to a range of 4% to 4.25%, down from a previous range of 4.25% to 4.5%.
While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings.
As we see in the dot plot, the market is still expecting another cut later this year, 2025, another cut in 2026, and another in 2027. These projections remain unchanged. For 2025 year-end, the median FOMC member projection is around 3.5% to 3.75%, and there seems to be more consensus around this range than before. Now, looking into 2026 year-end, the projection seems to be a bit more scattered, although the expectation is generally lower than 2025, with about 5 members projecting lower than 3%. However, some analysts have reported that, again, Powell is too soft and too late. On inflation, the spike occurred in the interval 2022 to 2024, and as of today, as we see in this diagram, it has been naturally absorbed by the market.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
So, what to expect after an interest rate cut? As Warren Buffett has repeatedly said, interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there is a very low gravitational pull on asset prices. What Mr. Buffett means in this quote is that the lower the interest rates are, the cheaper money is. And the cheaper money is, the easier it is to fly, or rather, in the stock market, the easier it is to invest in projects that will materialize in the very far future. In other words, it creates a time distortion, making projects with lower temporal preference more interesting, while at the same time making higher temporal ones less attractive. However, the boost created by this time distortion is not something to be abused. On one hand, when the interest rates are kept artificially high for long enough, we run the risk of entering a recession, as the economy will slow down far beyond recovery. But on the other hand, when the interest rates are kept artificially low, then the boost will make viable bad projects, and therefore bad investments, that otherwise wouldn't be. And that's the seed for a bubble, and we all know what happens when it explodes. Nevertheless, as investors, is it worth keeping always a long-term horizon, since over time, irrespective of the interest rates, the market will keep growing. So, which companies can benefit from this boost? The first company is SoFi. For SoFi's lending business, the logic is quite simple. They make money out of arbitration between the interest paid by the customers and the cost of the capital, minus any potential write-offs. If the interest rates are lower, SoFi will charge less interest to its customers, but in exchange, that capital will be cheaper for SoFi as well, yielding a relatively similar net income margin. As we see in this figure, the net income margin has moved from 5.4% in 2022, when the interest rates were almost zero, to 5.86% in 2025, when the interest rates peaked above 5%. Therefore, it is logical to expect that in a scenario of interest rate reduction, the margin will move in this range. What is the catch then? Well, the cheaper the interests are for SoFi's customer, the more inclined they will be to take a loan. So we should expect a larger amount of lending originations, which, as we discussed, they will be at a similar net interest margin range. More people lending at the same margin means further increases to SoFi's lending business revenue. The second company is Amazon. Yes, that's right, Amazon. For Amazon e-commerce business, the logic is also simple. Nearly 1 in 5 American customers use buy now, pay later regularly. As of 2025, more than 91 million customers use buy now, pay later services, a number that has skyrocketed since the pandemic and which doesn't show any sign of deceleration. In fact, projections put this number well above 100 million users in the next few years. Buy now, pay later is essentially that. You buy a product or service today, and instead of paying it right away, you defer the payment to the future. In other words, customers take a loan from the seller for the amount of the purchase. In a scenario of lower interest rates, money is cheaper, so deferring payments become also cheaper. This benefits Amazon twofold. First, customers will be more inclined to spend even more as the deferral penalty becomes lower. And second, Amazon can bear the cost of these loans much easier, so it can make more. The third company is Klarna. Klarna is a company which just had its IPO earlier this month, and is currently holding the largest market share in the United States buy now, pay later, at 26.2%, and also has a 48% market share in Europe, making it a top provider in both regions. As we see in the projections, global buy now, pay later is expected to grow worldwide around 25% annually until 2030, and it doesn't show any signs of stopping. By 2028, the estimated buy now, pay later global payment volume is expected to be around $834 billion. This is a ridiculous number, which will only get further accelerated as the interest rates drop. Another catalyst for Klarna is the fact that in a lower interest rate scenario, delinquencies and credit losses are expected to decrease. This can be explained for two main reasons. First, since the interest rates are lower, borrowers will have increased ability to pay them. Second, as the economy gets boosted, jobs, and therefore salaries, are expected to grow, increasing borrowers' ability to repay their loans. Who knows? Maybe it's even a catalyst for companies of the likes of Taco Bell. No kidding! Klarna is currently offering buy now, pay later also for your burritos. One type of companies that will also benefit significantly from these rate cuts are those having a large amount of debt. The lower interest rates fall, the cheaper it will be for them to refinance their debt, saving millions of dollars in interest expenses. One of such examples is the case of Oracle, a company that has been lately performing very well in the market. They offer a comprehensive suite of corporate cloud applications and platform services, and have been investing very heavily in integrating AI with their cloud. However, as we see in the diagram, their debt has been increasing significantly, and it's currently above $105 billion. This high level of debt costs them more than $3.6 billion per year, just in interest payment alone. That's about a 20% of their operating profit. If Oracle is able to refinance their debt at lower rates, they could save a large amount of money in their bottom line, substantially boosting their earnings. Another example is the case of United Healthcare, the largest health insurance company in the United States, which is facing a similar problem than Oracle. Their total debt is currently above $79 billion. In the case of United Healthcare, every year they have to pay more than $4 billion just in interest payments. As we see in both of these companies, these are no small numbers that could eventually get cut off if the Fed continues easing their rate policy. We should take a closer look on how the situation evolves and keep all companies in radar and ready to fire. That's all for today. Just a quick reminder that this content is not financial advice. Please share your comments about what you think about any of these companies and whether you have plans to buy any of them. Don't forget to like and subscribe. Thank you very much for watching. See you all in the next episode.